Welcome to our in-depth tutorial on hedge funds. Today, we're going to cover everything you need to know about hedge funds, from basic definitions to advanced strategies, along with real-world examples, interactive questions, and detailed data analysis. First, let's start with the basics. What exactly is a hedge fund? A hedge fund is an investment fund that pools capital from accredited investors or institutional investors and employs various strategies to earn active returns, or alpha, for their investors. Unlike mutual funds, hedge funds have more flexibility in their investment strategies and are often managed aggressively to maximize return. Hedge funds can invest in various asset classes including equities, bonds, derivatives, currencies, and more. Hedge funds are generally only accessible to accredited investors due to their complex strategies and higher risk. Accredited investors are individuals or entities that meet specific financial criteria as defined by securities laws. Now, let's discuss some popular hedge fund strategies. One common hedge fund strategy is the long/short equity strategy. In this strategy, managers take long positions in stocks they expect to increase in value and short positions in stocks they expect to decline. This method aims to profit from both upward and downward market movements. For example, if a hedge fund manager is bullish on tech company and bearish on retail company, they might go long on tech company and short retail company. If tech company's stock rises and retail company's stock falls, the hedge fund profits from both positions. Another popular strategy is the global macro strategy. This approach involves making leveraged bets on price movements in equity, fixed income, currency, and commodities markets based on economic and political views of entire countries. A practical example of a global macro strategy could be a hedge fund manager predicting the Federal Reserve will raise interest rates. They might short long-term bonds or invest in assets that benefit from rising rates like certain stocks or currencies. Question: which of the following is a characteristic of hedge funds? Limited to stocks only. B. High flexibility in investment. C. Only available to non-accredited investors. Answer: now, let's consider event-driven strategies. These strategies try to exploit pricing inefficiencies caused by corporate events like mergers, acquisitions, bankruptcies, or restructurings. For instance, in a merger arbitrage strategy, a hedge fund might buy shares of a company being acquired and short the shares of the acquiring company. This strategy aims to capture the spread between current market prices and the offer price of the merger. Next, let's dive into quantitative or quant strategies. These involve using mathematical and statistical models to identify trading opportunities. Quant funds often use algorithms and data-driven approaches to make trading decisions. An example could be a statistical arbitrage strategy, where algorithms analyze historical price relationships between stocks to identify and exploit deviations from the historical mean. Question: which strategy involves using mathematical models to identify trading opportunities? A. Long/short equity. B. Global macro. C. Quantitative. Answer: hedge funds also come with various fees, commonly known as the 2 and 20 model. This means a 2% management fee and a 20% performance fee. These fees can significantly impact net returns for investors. Consider a hedge fund that manages $100 million and makes a return of 10% in a year. Under the 2 and 20 model, the hedge fund would earn $2 million as a management fee and $2 million as a performance fee. So the net return to investors would be 6%. So, what are the risks associated with investing in hedge funds? Hedge funds can be highly leveraged, which can magnify both gains and losses. They also have less liquidity compared to mutual funds and can have lockup periods. Moreover, hedge funds are less regulated compared to mutual funds, which can result in higher operational risks. This makes thorough due diligence critical before investing. Despite the risks, hedge funds can offer significant benefits such as diversification and potentially high returns, making them an attractive option for high net worth individuals and institutional investors. To summarize, Hedge funds are a powerful tool in the investment landscape, but come with their own set of complexities and risks. Proper understanding and due diligence are essential for making informed investment decisions. Thank you for watching. If you found this video helpful, please like, share, and subscribe. Feel free to leave your questions in the comments section, and we'll get back to you.